The March Consumer Price Index report is the first official inflation measurement to fully capture the economic damage of the Iran war oil shock. Headline CPI surged approximately 0.8 to 0.9% from February to March, driven by a 10.6% monthly jump in energy prices. Year-over-year inflation jumped to approximately 3.1%, up from 2.4% in February. Since the post-2009 recovery, only 5 months saw monthly CPI hit 0.9% or higher. Every single one landed between October 2021 and June 2022, at the peak of the post-pandemic inflation surge. March 2026 now joins that short, painful list. A hot print could end talk of interest rate cuts by the Federal Reserve. It could force Chair Jerome Powell to put a rate hike back on the table for the first time in years. Wall Street had been pricing in a significant jump, with estimates ranging from 3.1 to 3.7% year-over-year. The implications of this single data point rippled through every aspect of personal finance. Mortgage rates, savings account rates, investment portfolio allocation, credit card rates, the purchasing power of every dollar in your bank account. All of it shifts based on what this report says. I am the silent shift. In the next 14 minutes, I am going to break down everything. What this report actually means, the historical comparison to 2022, why the Fed is now trapped, and the complete 7-step plan for your money. Stay until the end. Section 1. What the CPI report actually says in plain language. Most people hear the term Consumer Price Index and immediately tune out. Let me make it completely concrete. The CPI measures the average price of a basket of things that ordinary Americans buy every month. Groceries, gas, rent, medical care, clothing, electronics, dining out. Everything. When the CPI goes up, it means that basket costs more. When it goes up 0.9% in a single month, it means prices rose almost 1% in 30 days. That is 11% annualized. That is not a small number. The driver of March's jump is energy, a 10.6% monthly surge in energy prices from the Iran war oil shock. Core CPI, which strips out food and energy to capture the underlying inflation trend, came in at approximately 0.6% for the month, implying a 3.1% annualized rate for core inflation. Here is why the distinction between headline and core matters for your financial decisions. Headline CPI surged because energy surged. But the Iran ceasefire that happened this week means energy prices are already starting to fall from their peak. The question for the Fed and for your mortgage rate is whether the energy spike was temporary and self-correcting, or whether it is the beginning of a broader inflationary surge that spreads from energy into everything else. The indirect channel of oil inflation takes longer: higher trucking and logistics costs, elevated manufacturing input prices, and airline surcharges. These pass through to prices for consumers over subsequent months. This means the full inflation impact of the Iran war oil shock is not fully captured in today's report. The direct energy costs are here. The indirect supply chain costs are coming in April, May, and June. Today's hot print is the opening act, not the full story. Section 2. The historical comparison to 2022 that should concern every investor. Let me walk through the 2022 parallel because it is the most instructive historical comparison, and because understanding it changes how you should be thinking about your portfolio right now. In 2022, the Federal Reserve faced its worst inflation in 40 years. The CPI hit 9.1%. The cause was a combination of pandemic supply chain disruptions and the energy shock from Russia's invasion of Ukraine. The Fed responded by raising interest rates from essentially 0 to over 5% in less than 18 months, the most aggressive rate hiking cycle in 40 years. The S&P 500 fell 25%. The Nasdaq fell over 35%. But here is the critical difference between 2022 and 2026. In 2022, the economy was still running hot from pandemic-era stimulus. Consumer spending was strong. The labor market was tight. The Fed had room to raise rates aggressively because the economy could absorb the pain. In 2026, the starting position is different. The setup: oil shock plus already sticky inflation plus a weakening labor market. This carries echoes of both 2022 and the 1970s. The question is which playbook the Fed runs this time. Every single one of the previous 5 months where CPI hit 0.9% or higher triggered an identifiable market rotation, sharp selling in high multiple growth stocks. Financial stocks dropped on rate hike fears, consumer cyclicals fell on spending power concerns, and defensive sectors held steady or moved higher. The investors who understood this pattern in 2021 and 2022 repositioned ahead of the market reaction. The investors who stayed in technology-heavy portfolios during those 5 high CPI months saw some of the largest drawdowns in modern portfolio history. The pattern is not guaranteed to repeat identically, but the directional forces are the same. And ignoring them because this time might be different has been historically expensive. Section 3. Why the Fed is trapped and what that means for interest rates. This section explains the most important macro constraint on your financial life for the rest of 2026. The Federal Reserve has one primary weapon against inflation: raising interest rates. Higher rates make borrowing more expensive. More expensive borrowing slows consumer spending. Slower consumer spending reduces demand. Reduced demand causes prices to stabilize or fall. It worked in 2022. It works when inflation is driven by excess demand. But the inflation we are seeing right now is not being driven by excess demand. It is being driven by an oil shock from a war that restricted 20% of global oil supply through the Strait of Hormuz. The Fed cannot raise interest rates to make oil flow through the strait. It cannot raise rates to repair Iran's damaged energy infrastructure. Because of inflation is geopolitical, not monetary, the significance of today's report extends far beyond the gas pump. It represents a fundamental challenge to the soft landing narrative that dominated 2025. Historically, when headline inflation spikes as sharply as it did in March, the Fed has been forced to prioritize price stability over economic growth, often at the cost of a recession. This creates what economists call a stagflationary trap. Inflation is high, suggesting the Fed should raise rates. Economic growth is slowing, suggesting the Fed should cut rates. The labor market is weakening, suggesting the Fed should cut rates. But if they cut rates with inflation at 3.1%, they risk letting inflation run higher. In the 1970s, inflation spiraled and the Fed was ultimately forced into the most aggressive rate hikes in its history, tipping the economy into back-to-back recessions. Inflation peaked above 13% in 1980, and the S&P 500 delivered roughly negative 2% per year in real terms across the entire decade from 1973 to 1982. Nobody is predicting a repeat of the 1970s. The ceasefire that happened this week changes the outlook significantly. But the lesson is that stagflationary environments, where inflation and economic weakness coexist, are among the most damaging for ordinary investors' long-term returns. And today's CPI report confirmed we are in the early stages of exactly that environment. The Iran ceasefire and the CPI report are two forces pulling in opposite directions simultaneously. Understanding both is essential for calibrating your financial response. The ceasefire is genuinely positive for inflation. Oil fell 16% the day after the announcement. If the ceasefire holds, oil will continue falling. This would reverse a significant portion of energy inflation. April's CPI could show meaningfully lower inflation, but today's CPI report reflects what already happened in March. The energy shock is already baked into the economy. Supply chain costs from oil at over $110 are still working their way through pricing. The inflation measured today does not disappear just because a ceasefire was announced this week. Economists warn the fallout from the Iran war could endure. Damage to infrastructure, higher shipping costs, and structural shifts in energy pricing mean the shock will likely have a long tail. As one economist noted, the economy does not just snap back. Both are true simultaneously. The ceasefire improves the outlook for future inflation. Today's CPI confirms inflation ran hot in March. The next 60 days of data will determine if this is a one-month spike or sustained reacceleration. Here are 7 specific moves to make after today's important inflation report. Ranked by urgency. Step 1. Move your emergency fund to a high-yield savings account immediately. Higher inflation and elevated rates mean high-yield savings accounts pay around 4% AP. Earning 0.5% versus 4% on $20,000 is $700 per year in free interest. This takes 10 minutes and has zero risk. Do it today. Step 2. Add tips to your investment portfolio. These are bonds whose value adjusts with inflation. When CPI goes up, your TIPS investment goes up. ETFs like SCHP, TIP, or VTIP offer exposure. Adding even 10% of your bond allocation to TIPS gives you direct protection against inflation. Step 3. Reduce exposure to long-duration bonds. When inflation rises, long-term bonds lose value. A 30-year Treasury bond can fall 20% or more. Shift toward shorter duration alternatives. Money market funds, short-term Treasury ETFs, or short-term corporate bond funds carry less interest rate risk. Step 4. Review your technology stock concentration. High multiple growth stocks bear the steepest losses. If your portfolio is heavily weighted toward high-valuation tech names, consider your risk tolerance. Step 5. Consider adding commodity or real asset exposure. Commodities maintain value during inflation. ETFs like PDBC, DJP, or GSG provide diversified commodity exposure. Gold ETFs like GLD or IAU. Adding 5 to 10% allocation toward real assets provides meaningful portfolio protection. Step 6. Pay down every dollar of variable rate debt this month. Credit cards above 20% APR. Variable rate car loans, home equity lines of credit. Every dollar of variable rate debt is a drain. The return on paying down a 22% credit card is a guaranteed 22%. No investment offers that. Step 7. Watch the April CPI release date, May 13th, as the most important financial event. Today's reading captured the peak of the Iran war energy shock. April will reflect the ceasefire. If April's CPI is significantly lower, it signals the spike was temporary and rate cut expectations return. If April's CPI remains elevated despite lower oil, it signals broader inflation is spreading. The Fed will need to act. May 13th is the pivot point. Mark it in your calendar. The data that drops that morning will determine whether 2026 ends with a rate cut or a rate hike. The March CPI report confirmed what economists feared most. Inflation surged to a level not seen since 2022. Energy prices jumped 10.6% in a single month. The Fed is trapped between fighting inflation and supporting the economy. Historical patterns show clear consequences for portfolios not positioned correctly. But the ceasefire also happened this week. Oil is falling. The supply shock is beginning to reverse. If peace talks produce a permanent resolution, April and May CPI reports could look dramatically better. Both things are true simultaneously. Today's data is concerning. This week's ceasefire is encouraging. The next 30 to 60 days will tell us which force is stronger. The 7 steps I gave you do not require you to predict which way this resolves. They work in both scenarios: inflation protection when inflation stays high, portfolio positioning that limits downside if conditions worsen, and systematic investing that captures the recovery. You have the data, you have the plan. The only question is whether you act on it. Subscribe to The Silent Shift for daily finance moves that translate economic events into what you need to do. The shift is quiet, but it is happening right now.